Back in the 80s and 90s, corporate America had a big problem. Shareholders, the owners of the companies, were convinced that their CEOs were getting lazy. They weren't acting like owners. They were acting like bureaucrats, playing golf, buying fancy corporate jets, and completely ignoring the stock price. The solution, proposed by top economists and consultants, seemed brilliant, almost perfect. Pay for performance. The logic was simple. Instead of paying CEOs a flat salary, pay them in stock options. If the stock price went up, the CEO would get rich. If it went down, they'd get nothing. This was supposed to create a perfect alignment of interests, kicking off a golden age of corporate efficiency. And for a little while, it seemed to work. But then something really strange started to happen. CEOs began earning astronomical sums of money, $100 million, $200 million a year. Yet, the companies they were running were often crashing, burning, or in some cases, committing massive fraud. You get an option to buy it at that same $100 price. If the stock price goes up to $120, you can exercise your option, buy at 100, sell at 120, and make a $20 profit per share. But if the stock drops to $80, you just don't use the option. You make $0, but importantly, you don't lose any money. This creates what's called an asymmetric incentive. The upside is potentially infinite, while the downside is capped at zero. Now, imagine you're a CEO with a million of these options. You realize that if you can just get the stock price to jump for a single day, you can cash out and make, say, $50 million. Does the stock price need to stay high forever? No. Does the company need to be healthy 10 years from now? Not for you. You just need a quick pop. This structure incentivizes short-term thinking and high-risk behavior. It basically encouraged the CEO to gamble with the company's future. If the gamble pays off, they win big. If the gamble fails, the shareholders lose everything. But the CEO just walks away, often with a generous golden parachute severance package. It's a classic case of heads I win, tails you lose. The poster child for this whole paradox is, of course, Enron. In the late 90s, Enron was the absolute darling of Wall Street. Its CEO, Jeff Skilling, was completely obsessed with the stock price. In fact, in the lobby of Enron's headquarters, there was a giant ticker constantly displaying the stock's value. Skilling and his top executives were paid almost entirely in stock options. So, what do? They stopped focusing on the boring but steady business of natural gas pipelines. Instead, they pivoted to what they called financial engineering. They used something called mark-to-market accounting. This let them book the future estimated profit of a deal on the very day they signed it. So, if they signed a 20-year energy contract, they could claim all 20 years of projected profits right now, today. This made their earnings look absolutely enormous, and the stock price skyrocketed. The executives cashed out millions upon millions of dollars, but the actual cash, the real money, wasn't there to hide the mounting losses and debt. They created a web of special purpose entities, like the infamous Raptors, designed to bury debt off the official books. It was a house of cards, built for one purpose, to pump up the stock price just long enough for the insiders to sell their shares. When it all came crashing down in 2001, shareholders lost $74 billion. Thousands of employees lost their jobs and their pensions. But the top executives had already walked away with hundreds of millions. The incentive system had worked perfectly. It maximized the stock price, just only temporarily. Now, let's fast forward to 2008 and the global financial crisis. The CEO of Lehman Brothers was a man named Dick Fuld. Banking is supposed to be a business of managing risk. But Dick Fold's compensation incentivized him to take on as much risk as possible. Lehman Brothers leveraged itself 30 to 1, meaning for every dollar they had, they borrowed 30 more. They used this mountain of borrowed money to buy risky subprime mortgage-backed securities. Why? Because in the short term, this generated massive fees and profits, which in turn boosted the stock price and Fold's bonus. Between 2000 and 2007, Dick Fold made nearly $500 million in compensation, most of it performance-based. When the housing market inevitably turned, that 30 to 1 leverage became a death sentence. It wiped the firm out completely. Lehman's bankruptcy triggered the worst financial crisis since the Great Depression. Yes, Fold lost a lot of his stock in the final collapse, but he got to keep the hundreds of millions he had already cashed out in the years leading up to it. The pay structure had encouraged him to pick up pennies in front of a steamroller. Eventually, the steamroller won. Today, a modern version of this paradox plays out through stock buybacks. A buyback is when a company uses cash to buy its own shares from the open market. This reduces the total number of shares available, which mechanically increases the earnings per share and usually the stock price. So, if a CEO runs out of good ideas for new products or ways to grow the business, which is hard work, they can take the easy route. They can spend the company's savings on buybacks. This artificially inflates the stock price. The CEO's options become more valuable. They cash them out and they get rich. But what happened to the company? It just spent its cash reserves. It didn't invest in research and development. It didn't build new factories or train its employees. It has essentially hollowed out the corporation to pay the executive. The company is literally cannibalizing itself to feed the C-suite. Studies consistently show that companies that engage in aggressive buybacks often underperform in the long run because they are starving their own engines of innovation. So, why is this problem so difficult to fix? Economists have a name for it, the multitasking problem. A CEO has many different jobs. Number one is to increase profit, which is easy to measure, but they also have to maintain a healthy company culture, manage long-term risks, and plan for the company's future 10 years from now. All of these other tasks are very hard, if not impossible, to measure today. When you attach a huge financial reward to that one easily measured metric, the stock price, the CEO will rationally focus all their energy on that and ignore everything else. Think of it this way. If you pay a surgeon only for speed, they'll operate incredibly fast, but they might forget to wash their hands. If you pay a CEO only for share price, they'll pump the stock, but they might destroy the company's culture and future in the process. The stock price, it turns out, is a noisy proxy for real value. It captures market expectations, not necessarily reality. And as we've seen, expectations can be manipulated. So, how do we fix CEO pay? Reformers generally suggest two major changes. First, move from options to restricted stock with long-term vesting periods. This means giving CEOs actual shares, not just options, and more importantly, telling them you cannot sell these shares until 5 years after you leave the company. This creates a much longer horizon. The CEO now has a personal stake in whether the company will still be healthy and thriving in 10 years. They can't just pump and dump because they're not allowed to dump. Second, we need stronger clawback provisions. This means if a company goes bankrupt or is found guilty of major fraud, the CEO has to give the bonus money back. The Sarbanes-Oxley Act introduced a version of this after Enron, but it's rarely enforced with real teeth. Strengthening clawbacks completely changes the risk equation for executives. Now the thought process becomes, if I cheat and get caught, I'll lose the money I already made. Ultimately, the CEO pay paradox is a powerful lesson about measurement. We thought the stock price was the ultimate measure of corporate truth. We forgot that markets can be irrational and that numbers can be cooked. By tying unlimited wealth to a single volatile and gameable number, we accidentally turned many of our business leaders into short-term gamblers. We created a class of mercenaries who have no long-term loyalty to the institution, only to the ticker symbol flashing on the screen. Real, Sustainable leadership involves doing the hard things that don't pay off immediately. It means investing in people, building resilient systems, and researching wild ideas that might fail. If we want our CEOs to act like true stewards of the future, we have to stop paying them to loot the present. Thanks for watching. If you found this interesting, consider subscribing for more deep dives into business and economics.